Today, the widening Middle East war pushes oil prices up again and rattles world markets.
Plus, US Treasury yields climb as inflation fears outweigh any safety bid.
And central banks in Japan and Switzerland threaten intervention to keep their currencies in check during the turbulence. This is Reuters Morning Bid, bringing you unfiltered market news and analysis straight from the Reuters newsroom 7 days a week. I'm Mike Dolan in London.
And I'm Amanda Cooper. It's Tuesday, March the 3rd. So here we are, Tuesday, stocks under pressure, oil climbing again, natural gas in Europe spiking almost another 20% in opening trade. And that where you'd expect to see a safety bid is kind of showing up in gold to an extent and the dollar, but the dollar isn't really getting a safety bid, is it?
So no, it's not really a safety bid as we used to know it, where people kind of hoarding dollars for safety in times of turbulence. It's more a kind of relative play that people are trying to calculate who wins and loses from a big energy price spike around the world. And clearly, if you look at the big Asian economies, Japan and China, they're very exposed to oil, particularly oil coming from the Middle East and particularly oil coming through the Straits of Hormuz. In Europe, we've had, as you mentioned, this huge gas price spike, which kind of reminds everyone again of what happened after the Ukraine invasion and how much turbulence it created in Europe. And then, you just have to look at the US's position in energy, where it's a net exporter generally of energy, including petroleum products and natural gas. So on that relative scale, the dollar's been bid up. And I think so we then have to go back, as we do for all other markets, and see what's the duration of this conflict, how long do oil prices stay up there, and when do they start to feed through. But we're in day 3, and there's absolutely no sign that this is going to come to an end anytime soon. And we're going to talk in terms of weeks here rather than days, I think that's for sure. So one of the peculiar things was how Wall Street bounced back quickly last night. What do you think was behind that?
It was bizarre. If you ask me, I was not expecting to see that at all. I mean, going into yesterday's pre-market, we had futures down to the tune of 2%, very much aligned with what we're seeing in the rest of the world. And then as we kind of come to the opening bell and trade starts up, even with the dollar bid, even with Treasury yields spiking, even with those inflation concerns taking root, it felt like those beaten down parts of the market, the parts that perhaps we've been writing about and talking about being disrupted by AI, tech, software, and so on, catching a little bit of a tailwind, getting bid up, perhaps people are taking this as kind of a reasonable time to buy because why not? And that sort of meant that Wall Street ended fairly flat yesterday, which was, as you say, I mean, the typical playbook that we dust off in these situations has, it's got some different footnotes to it this time.
Yeah, there is a sense that yesterday, certainly when we got to Wall Street, it was different around the world, it has to be said. But the people, it was almost like programmatic trading, because we've seen this before, it goes away after a few days. This is a very different situation. And you see this morning as we come in through Asia, South Korea, which was closed on Monday, it has to be said, but down 7%. Now, that was one of the best performing markets of the year so far, as we talked about last week. Up almost 50% for the year to date at one point last week, but 7% drop. That's a big move. And again, in Japan, 3% drop in the Nikkei, 1% off again in China, and US futures, despite that bounce back, are deep in the red again before today's bell. What's going on in the Treasury market, the interest rate market? This is kind of a fascinating push-pull.
Absolutely. I mean, again, as I said, it sort of felt like, safe haven situation. We know what this looks like. It means, gold up, Treasury yields down. No, Treasury yields up, and up quite sharply, particularly at the short end of the curve, that part of the curve that is most sensitive to rate expectations and so on. And interestingly, with the spike in oil, with the spike in gas, I mean, this really throws a spanner in some of the central banks' plans, doesn't it? Especially those that, like, for example, the ECB, which was broadly expected to remain on hold, possibly even cut. The Bank of England that was expected to deliver 2 cuts, that kind of pulled back. Even the Fed curve, like Fed expectations, now it's not fully baked into the cake that there'll be 2 cuts this year, right?
Yeah.
So I think Treasury is reacting to that. If you look at various market-based gauges of inflation expectations, those are kind of picking up. You might hear terms bandied around, right? Like break-even inflation rates, forward inflation swaps, and so on, all pointing to this not going away in 5 minutes.
I think one of the fascinating things yesterday was, while everyone was watching, obviously, the escalating conflict across the Middle East, and it is a regional conflict now, that actually, more prosaically, we got US factory readings for February that showed input prices jumping 10 points on that scale, which is the highest or the biggest jump they've had in years, certainly the highest level of price rises recorded since 2022. And this was even before this oil price spike and this conflict broke out. So if you add that on top, you really do have very big question marks for the Fed there. And I think also you have to ask the question, how does it play into President Trump's calculus about how long this war will go on, how long the US will continue to prosecute this war, because he's in an election year and this sort of inflation spike will potentially come to haunt him.
Well, exactly. I mean, the average prices at the pump as of this morning were just below $3, roughly where they were a year ago. I think it was Marco Rubio yesterday who said that the White House today is going to announce initiatives to at least limit the prices at the pump. I mean, that's where people feel things first, right?
Final point just on some interesting developments in the currency markets. We've had two central banks, Bank of Japan and the Swiss National Bank, both warning the markets that they will have to intervene to keep their currencies in check, but for different reasons.
Yeah, exactly. On the one hand, you've got the yen, Japanese yen, which has been weakening almost non-stop, bar a few spikes here and there. Bank of Japan concerned about what that's going to do for import prices. Like you said, you mentioned Japan, a major oil importer. It's getting a double whammy right now. And then on the other hand, you have the Swiss, whose franc currency is hurting their exporters. So you've got this, like you say, push-pull there that again removes that or makes that kind of obvious choice of those two currencies as havens a bit less clear, right?
Right.
For today's recommended read, check out Mike's column on how the dollar might be getting its mojo back. The link is in the show notes.
For more on any of today's stories, head to Reuters.com or the Reuters app. Follow us on your favorite podcast player, and if you're on a smart speaker, just ask for the latest market news from Reuters, 7 days a week.
We'll be back tomorrow.